Hi you guys, welcome back to the channel. I've made a show about this before and I feel like it's a super nice day out here, February, and the sun is out. I couldn't be happier. So I'm going to make another quick video on investing and my acronym K.I.S.S. Keep Investing Simple, Stupid. Coming up next, Firefighters Financial Toolbox. Hi guys, welcome back to the channel. My name is Brad, this is the Firefighters Financial Toolbox. Today we're going to talk about an acronym that I feel sums up investing for the masses. K.I.S.S. Keep Investing Simple, Stupid. I have 5 simple rules that can help you stay the course, invest, and have a good outcome in the long run. First one is, if you don't understand it, don't invest in it. Okay? Let me give you an example. I don't understand how Bitcoin works. Now, I'm sure that if you got in on that really early, you made some money. But I don't understand it, so I don't put money into it. Now, there's a lot of people who don't understand how stocks work and how bonds work and that kind of stuff. That's the kind of stuff you can actually get online and learn pretty well. All right? If you don't understand it, don't invest in it because you're going to lose and then you're going to hate it and you're not going to keep on investing. All right, second thing is invest early and often. Or as I like to say, early and regularly, you guys. The earlier you start in life, the longer your money has to compound, the more money you're gonna have when you decide to take it out in retirement. Same thing with a taxable account. If you need the money, let's say you're saving for a house down payment, the earlier you get that started, the faster it's gonna grow. And with that, remember, use your tax advantage space. If you have a 401k at work, use that. Get the match. If you haven't started a Roth IRA, start a Roth IRA. If you're eligible to contribute to one, you guys, start it now. It's tax-free growth for up to 30, 40 years if you're young enough. All right, it's really important. Early and often, early and regular. All right. Number 3, keep your costs low. How do we do that? We invest in low-cost index funds and ETFs at a low-cost brokerage house. Fidelity, Vanguard, Charles Schwab. M1 has a good assortment of low-cost ETFs that can help you, and you can do it all online or on your phone. It's easy, it's simple. And now with the fact that pretty much all your discount brokerages don't charge a fee for buying individual stocks or securities, it's a good time to be an investor, you guys. So keep your costs low. Remember, high cost mutual funds that charge upwards of 1 to 1.5% is going to eat away at the money you're going to make from this. Don't do it. Low cost funds, low cost brokerage houses. Make sure you know what your fees are when you pay them. Same thing when you invest in your company plan. If you're at work in your 401k, look at those expense ratios. Make sure you pick the lowest cost fund that's going to help you get what you need. Using broad market ETFs. Number 4, my favorite way. There are people that know how to pick stocks, and they pick stocks and they're good at it. Now, some are good, some aren't very good. Some think they're good and they turn out. Here's the thing. If you buy 10 stocks and you pick 10 winners, you have the biggest potential to make a lot of money. But if you pick 10 losers, you could end up losing it all. Using a broad market index fund or ETF gives you broad diversification at a low cost, and it's simple. Remember, keep it simple, stupid. When we're talking about what kind of market funds do we use? Well, you need some United States stocks. We're in the United States here, so some sort of total U.S. stock market. Or even an S&P 500 fund. With the S&P 500, you're getting 500 biggest companies. Those are the biggest movers and shakers in America. Again, super low cost, pretty good diversity. Then you need some sort of international fund. If you can find a total international stock fund, awesome. Because then you'll have the big developed markets and you'll have some emerging markets. If you can't find that, go with some sort of developed market fund. So it's going to have all your big players internationally. Bonds. I feel everybody who has not been through a downturn should have at least some bonds. Now, bonds are really controversial right now, and I understand. They don't pay anything. You guys are not there for paying. They're there for security. Now, I'm not going to get into telling you asset allocation is a personal choice. You know, asset allocation is your percentage of stocks, your percentage of bonds, your percentage of cash. And then it goes on to break it down into your percentage of international, U.S. bonds, maybe international bonds, maybe some commodities, some other stuff, and then how much cash. That's a personal choice. But remember, when the stock market goes down, and it will, it always will, okay? At some point, we've been on about 11-year run where it's just been going like a skyrocket. Eventually, it's going to flatten out and go down. Having the bonds can help smooth out the ride, okay? Okay, my fifth and final rule is ignore your TV and stay the course. It's real easy when you see the TV. Anytime the market starts going down, the pundits on TV start freaking out. Oh my gosh, we gotta sell, we gotta sell. Here's why, you guys. They get paid when you sell. They get paid when you buy. They get paid anyway. They want you to be fearful. They want you to make brash decisions. They want you to do transactions, because whether you're buying or selling, they're gonna make money. Ignore it. Pick your plan, stay with your plan, invest early, often, keep it on autopilot, you guys. You're gonna win in the end. I hope you got something out of this. If you did, give me a thumbs up. If you're new to the channel and you're not already subscribed, smash that subscribe button and come on back. We try to do a couple shows a week. All right, thanks.